Now, for somebody who keeps an eye on risk so closely,
Yeah.
what do you make of the India VIX right now? May last year, I think it was at 26, 27. Now it's languishing at 12. Does it worry you as an investor or a fund manager that the India volatility levels have fallen to such low levels?
So then it's an interesting question. I will put this perspective. See, a lot of people have just started looking at VIX, and a lot of people look at VIX in isolation. Okay. The way we explain the phenomena is that overall derivative volumes have declined significantly. People, the market participant, have hardly any exposure left in the leverage market. In this background, the importance of leverage data also comes down significantly. Let's say give you some more example. Okay, when Bitcoin was in a right from 2015 onwards or 2012 onwards, we have seen some new animal which known as the cryptos came to the market. But if you look at in last 1 year particularly, okay, money flow towards crypto as an asset classes has come down significantly. And earlier we used to look at crypto data or the cryptocurrencies data as a risk appetite indicator for the young generation or for certain countries. Now, if overall volumes has come down significantly, and hence the this concept of risk appetite for young generation has been lost. So it's very important to understand the contribution it is making. Let's say example, one more example I'll give you, crude. Okay. Today is still very, very important, but the relevance of crude has declined over a period of last 10 years as compared to natural gas. And now maybe in future it will get declined further because the renewables are coming. So it's also very important to understand what role that particular asset classes or stock or sector is playing in the overall perspective. If overall volumes of the, let's say, in Indian derivative market has come down and his relevance is also declined. But the low walls or sticky walls which VIX is showcasing right now, it also showcase some signs of vulnerability at some point in time. Okay, if some global events unfolds, okay, it has the probability that VIX can also spike. So we have to look at from both perspective. One, if just looking at the VIX, can you get all the answer? Answer is no, because the selling which happened in the market was predominantly the ETF-led selling. Okay, the passive fund selling which was there and which has no impact on the VIX as or the derivative market as a whole. So that's the reason we can say the relevance of VIX has declined in today's context. But you cannot ignore it also completely. As I said, it's a low walls also means a sticky walls, and if some events unfold, it can spike significantly.
Mm. How are you characterizing this current up move in the market, Sandeep? I mean, does it strike you as a relief rally because people have become too pessimistic, or is this the start of a new trend?
So yes, people were very pessimistic. If you really look at a month back or last few months data, in generally people are tired, people have given up, there's hardly any interest. Even if you look at from the market momentum point of view, when you look at it has become a largely institution player versus real retail. So the in between the layers of the family office or ultra HNIs or HNI or real retail player who was participating in the market, their participation has gone down significantly. And then if you really if I have to quantify in terms of Quant fear index, okay, it was in some of the stock it was as high as pre-COVID level, and in some of the names it has spiked, and that's the reason we have seen this sort of sharp recovery which is happening, because nobody wants to participate in this rally, and market was very light. So the impact cost, then if I have to put it statically, the impact cost in the market has gone up significantly. So market has fallen with low volume, and similarly market has rallied also with low volume because the impact cost is very meaningful.
So, to come back to my question, are you still characterizing this as a relief rally, or do you think it can take the market back to that old high?
So if you really ask me the way, then we don't analyze in this manner. Yes, there could be some sort of pause. Maybe if this rally momentum continues, like a lot of people are looking at 17,800 as a important level. If it breaks, then 18,200. We don't look at the market in this manner. The way we manage our money is that any given time we play or try to generate alpha through sector rotation or stock rotation. Okay, because we are traditionally a long accounts mandate which we have. Because if you really ask me, yes, 2023, I have been talking about This is the culmination of a volatility expansion phase we have been talking about right from 2018 till 2023. This is the volatility expansion phase, which means the employed vols of the global asset class will remain elevated, and this is the peak year of that. And when we say this is the peak and the final year for that, typically the employed vol will spike further at the peak of the cycle. That's the reason we say that it can only spike with some event which can unfold. But you also keep in mind, if this is the culmination of that phase which is getting over, it means any dip which can come for any global event used to be buying opportunity, because Indian macros are far superior. I don't think in last 30 years of my career, we have seen all good data points are there. So very, very compelling case for a long-term investor. So we remain very constructive buy on dip strategy. We like to play through this route, and the sector rotation really help us. So we are not trying to time the market, trying to say whether this is a breakout zone or it can correct further. The way we are looking at, yes, we are still in risk of environment.
If you like the video, do like, comment, share and subscribe.